With inflation picking up steam and everything converging here in 2021, how will this all play out? You came here for the truth, so let me unveil that for you. I've got a really big video. This one is going to get into a lot of different topics. The first thing I want to talk about is the job situation that made the stock market continue to escalate to new heights. Okay, then I want to talk about broke. That's right. Most people today, they're broke. J-O-B, your job, just over broke. You've heard that one before. And then the third thing I want to talk about is H2, which is the second half for stocks. The second half for stocks, what Bank of America believes will be coming. Let's go. So this was the big news of the day. US adds 850,000 jobs in June, better than expected. It's always based on the expectations. We knew this was happening, of course. We knew that it would look better. You could see it statistically on this chart right here. It was starting to come down. At this point, it bottoms out in December. And why? Because of all the situations, the closures and, the lockdowns and so on. And then ever since, on average, it has been going upward, and the jobs largely were around travel and tourism and hospitality and so on. So you're seeing a lot of restaurant workers getting back. You're seeing a lot of businesses that are opening up as the restrictions lift. So these people are getting their jobs back. But there's something about that I want to touch on today. But let me just stay on this theme for a second here. This is the statistics going back over the last year, and you could see what had happened. Okay, so there was this huge surge afterwards. The main lockdowns started to expire and so on. And then you had this big change that has been going on. Certainly the numbers are looking a lot better than they were a year and a half ago when everything was shut down. But at this point here, we got to understand what's underlying all of that. Still solid, U.S. manufacturing gauge remains robust while inflation pressures build. This information comes out of Bloomberg, and what you're seeing here on the top chart is the Purchasing Managers Index, the strongest reading since 1983. But at the bottom, I think this is really important. Index of prices paid is the highest since 1979. If you remember, during this time frame, we're talking about heavy inflation. And understand that inflation doesn't happen over a long period of time. If you look at the hyperinflationary scenarios in the past, all the way back to the great inflation of Athens, and you see right through every single time, it was faster than anyone predicted. So this is always the way it works. Oh, there's no inflation. Don't worry, it's temporary. And suddenly it gets out of control. Things like this can happen in an instant. But the point is, for you, what you pay on everything, they're all increasing. We'll talk more about that in a second here. United States factory orders. This has been a little bit iffy over the last little while. But at this point here, it's just showing you that it surged 1.7% month over month. And you want to see this type of data in terms of, whatever's coming out of factories, anything like that. You want to see shipping, you want to see the logistics of all aspects to that, basically being in the positive territory, in the bullish territory, because that gives you some insight as to what's happening in the economy as a whole. But when you factor in the prices that are being paid, remember, if suddenly everything became more expensive, that looks better on the GDP. So you got to take this with a grain of salt. Always understand the fine print. You've got something coming out of the Federal Reserve. This happens to be the San Francisco president saying something that I think it summarizes it. Today's jobs report just says we're on our way. And that's what they've been talking about. Oh, we can't define what's going to happen in the near future. We need to be able to be certain about it. We have to be actually making progress on the way there, and not just simply, looking like we're going in that direction. Okay? This is giving them a little bit of leeway on when they can actually start to taper and, of course, increase rates. And you see what happens with the actual trade deficit in this case here. It's looking terrible. And this is something that I quoted in my book. And to paraphrase, essentially, there was a quote that I used in there that said, whoever is owing all that money back with all this debt is ultimately a slave. Now, I butchered the quote here, but you understand what I'm saying. This is not sustainable. Debt and deficits are never, ever a good idea long term. The US economy will roar back to life for the rest of the year and remain supercharged throughout 2022, according to the CBO, the Congressional Budget Office. But through the analysts who warned, though the analysts warned that Americans can expect inflation to rise sharply for several months. Remember what they're saying here. The CBO is telling you this. This is a government agency telling you this. Look at all the different government agencies that have been saying the same exact deal. Okay? They're going to tell you anything you want to hear when you talk about the main numbers, but look at their analysis. Look at their reports. Look at this. Manhattan real estate prices reach record as buying frenzy takes hold. Manhattan, of all places, is starting to go crazy. And then this generational shift, and this is going to move into the paycheck to paycheck situation, which I think is critical. And of course, that's the reason why this video is surrounding that. All of that to get to these points here. Older Americans have accumulated a record amount of wealth and are projected to hand down some $70 trillion by 2042. This right here could be something that certainly makes a difference. You look at not just the demographics of the United States and most other countries, but you see on the other end of it, what's going to fill the void? If there aren't all these people paying into the Social Security, Medicare, Medicaid, unfunded liabilities, how does that void become filled? And may I say it? May I? Is anybody going to get triggered by this? You are going to pay higher taxes and you're going to get your benefits slashed. They're going to be slashed. Okay? Not like Guns N' Roses, okay? No, I'm talking about big cuts. All right. Living paycheck to paycheck. Nearly 28.4% of Americans rely on their next paycheck to keep themselves afloat. Wow. Now, of course, as always, it's a survey, okay? 2,000 adults, but it gives you an idea of what's going on. And this right here, these numbers, I would say it's probably worse, actually. But anyway, it turns out that approximately 72 million employed Americans, 28% of the population say that they couldn't get along financially for more than a month if their payday wasn't on the horizon. An additional 24% can survive between 2 and 6 months. That means an estimated 133 million employed Americans, or 52% of the population, can live off their savings for 6 months or less before going broke. Okay? Now, this is huge. But of course, we've talked about this before. But look at what's coming. You've got inflation basically squeezing people this way. You've got their wages coming down this way in real terms, and actually nominally for a lot of people. And what does that do? Well, that provides a shrinking amount of money that could be spent into the economy. What are we doing today? We are borrowing from the future to have growth today, so that we don't have a correction today, which makes everything cheaper, so that these house prices can come down, the car prices and all these different things could come down in price, so that you can purchase things for cheaper. If you were prudent, if you were wise, and you saved your money for a rainy day, you would have it for the time in which things are on sale. But no, everything gets pushed up, you get squeezed, and you suffer the consequences, okay? And then you have this student debt, essentially just showing you $1.7 trillion in student debt today. And they make a very good point in the CNBC article. The moratorium for the student debt is set to expire on October 1st, and politicians and experts warn that millions of borrowers may be thrown into extraordinary financial hardship when payments resume. I don't know what's going to happen, will they extend it or not, but ultimately, you've got this huge pile of debt, whether it's coming in the form of mortgages, whether it's coming in the form of student debt, and so on, that people simply cannot pay back. Number one, people are getting jobs, but they aren't paying the bills. Number two, with inflation rising, risk-taking increases. Number three, investors, listen up closely, watch the Federal Reserve and their moves to decide how the market is going to move. Here we go. Let's look at these pieces of information. You could see I'm going to try and not go anywhere. California's gas tax increases again on July 1st. People are paying more for everything. You know that, and it's going all over the place. But you could see commodities, as we'll talk about in a second, but also stocks and their performance over this period has enriched some people. There's no doubt about it. The first half of 2021 was the 7th best for global stocks in the past 100 years. You could see those points here. It is looking crazy. There's no doubt about that. And it was also the 5th best for commodities in the past 100 years. This doesn't happen too often. In fact, the performance was even better than the run-up in 2008, which was considerable. Not necessarily every commodity like oil, I think it hit $147 a barrel back then, but you just look at the basket of commodities in general. Tech, financials, and energy dominate the top 20 distribution. So you could see the names of these companies. They're familiar to you. Microsoft, Alphabet, Facebook, Nvidia, and so on. And by the way, Exxon is still on there. That's the top 20 stocks right now. And you look at what had happened during this period, and certainly more and more money running in to the big names. Top 5 S&P 500 stocks, still 22.4% of the index. It's come down from about 24%, but it's still truly excessive. Okay, that is something you generally don't want to see. There's always going to be the biggest names. We know that. But it's nothing like we've ever seen before. Look back in 2000, Microsoft, GE, Cisco, Intel, and Walmart. And now today, you've got this massive concentration. And this is how I wanted to leave the video off today. Okay? You've got a hyperinflationary scenario going on all over the place. One of those extreme examples being Venezuela. You've seen them in the past. Now, I'm not suggesting that we will encounter a hyperinflation. I really don't know. They might figure out a way to completely disrupt the financial system before it gets to a Venezuela level. But we can certainly learn a few things. Look at Venezuela. They're going to cut 6 zeros off the Bolivar to simplify transactions because people don't want to be bringing wheelbarrows around. So what are they going to do? They just cut 6 zeros off, and that buys them a few months. We need to learn the lessons from what we're seeing here right now. It would be very, very prudent to do so. If you want to be able to get in touch with me, if you want to learn from me and what I've got going on, well then the Insiders is the way to do that. For right now, this is basically going to email you the video of the day 5 times a week. In a very short period of time, I'm going to be including original content in here. You're going to get information directly from me to you, to your inbox. You could sign up for free, themoneygps.com. If you found the video informative, hit that thumbs up button. I really do appreciate that. I definitely want to support me if you can. I do appreciate it. Thank you. If you haven't seen this video yet, you definitely want to check it out. Click it and I'll see you there.